Alright, so what is Forex? The foreign exchange market, or Forex in short, is the largest market of tradable financial assets in the world. There's also a sure known fact that the Forex market is the most liquid market in the world. But what does that exactly mean when we say the most liquid market? A liquid market is one where there are a lot of participants available in the market, also known as a lot of buyers and sellers interested in grabbing the best possible price for the currency pair that they are trading. This is in fact great for traders because due to the amount of participants in the market, it is relatively easy and fast to execute trades and at the most desired price. The Forex market is not only big, but it's also open 24 hours a day, only closing on weekends. So what can you trade in Forex? Currencies is one that first come to mind. For example, Forex trading can be confusing at times because of the pure fact that you're not taking ownership of a tangible object. It is not the same as buying a car where you later have to sell it for a profit. Think of trading as you, the trader, investing in a country, the currency, almost like buying shares in a company. The price that you receive of that specific country usually reflects the economic health of the country. So what else can you trade? Well, commodities and indices are two different types of financial instruments that can be traded in the financial market as well. Commodities are raw materials or primary agricultural products that are traded in bulk and used in production of goods or services. For example, commodities include crude oil, gold, and silver. Indices, on the other hand, are financial instruments that represent the performance of a group of stocks or other assets. For example, some popular ones are the S&P 500, the Nasdaq, and the Dow Jones. And lastly, crypto trading have grown significantly popular as well. Now let's talk about contract for difference. A CFD is a product offered by a broker whereby the prices we see and trade are derived from the actual prices. Instead of actually owning the underlying asset, the trader enters into a contract with the broker, which allows them to speculate on the price of the asset. When trading CFD in Forex, the trader takes a position on whether they think the price of a currency will rise or fall. If the trader predicts the direction of the price movement correctly, they can take a profit. If the trader is incorrect, they will incur a loss.